and welcome to the download. I'm your host, Dave Richardson, and as you can see, we're on video today. For the first time, you get to see, although you've probably seen him on all the other videos and other things that he does and his many, many television appearances, Academy Award-winning movie roles. Eric Lascelles, Canada's hardest-working economist. Eric, welcome to the download again.
Hi, everybody. I'm wearing proper clothing from the waist up, so that's all that matters, I'm told.
That is all that matters. And although we're going to get into some pretty meaty stuff today. Now we had you on earlier this week to talk about a lot of significant movements in terms of central banks cutting interest rates. Bank of Canada, in particular, has gone through 2 cuts. We were sort of looking at the odds of the Federal Reserve, who was making a decision this week, and then more thinking that they would stand pat as they did. And then we would get to September and looking at the odds that they would cut in September. And we said, well, it's really good. We're going to do this update in between the jobs reports, but we'll have you back on Friday for the jobs report because that'll be pretty exciting. And I don't think we really thought it was going to be quite this exciting, what we're seeing going on in markets today.
Yeah, you're quite right. So, for those who aren't following along or maybe watching a little bit later, I don't know how this works, but markets are recoiling pretty significantly, not feeling happy. Risk assets are off, and we were talking just before, the VIX is up, reflecting a lot of uncertainty. And so really this all circles around to the U.S. payrolls number that was just released for the month of July, and it added a mere 114,000 jobs. The expectation had been 175,000. And so, and I should say the details are soft too, and so they, negative revisions to the prior few months to the tune of 29,000 jobs, and aggregate hours worked were down 0.3%, which is a fair drop in the total number of hours all Americans are working. And that other household survey that likes to bounce around, it was a slight negative. So, the negatives were lining up there pretty significantly. And I guess as a function of all that, the unemployment rate then rose again. So it's been rising a little bit here and there, but up from 4.1 to 4.3%. So that's a fair sized jump in a single month. So it was weak. It wasn't distorted by Hurricane Beryl, we're told, and so it's not that was the story. I guess a couple thoughts. So, like one would be 114,000 is certainly weaker than we've seen in a while, and it's a softish number. It's not a total disaster. Like it's there are still jobs being added. It's a little worse than you might normally say it is, just because we do happen to know that there's a lot of sort of undocumented immigration and population growth in the U.S. that would normally desire a faster rate of job growth. That's why the unemployment rate went up. But it is still a positive. One interesting thing is that the U.S. actually had a weaker month of job creation 3 months ago. In the April data was 100, I'm looking here, 108,000 jobs. But here's the thing. The negative revisions have been so reliable and metronome-like that you would probably assume this 114 gets revised down over the next few months in a way that maybe it is the new low. But I guess the broader story is one in which, this is always an important indicator. This is a weak release. By itself, you wouldn't say this warrants, the magnitude of the stock market move and everything else that's happened today. But, when combined with the fact that we've been seeing, hints or more than hints of weakness in a lot of other places. And so, the ISM numbers have been soft and sub 50. And in fact, the ISM manufacturing was out yesterday and quite soft again. And other things have been decelerating pretty clearly as well. And this seems to be the straw that breaks the camel's back in terms of people no longer saying, hey, slower growth is good because it's the soft landing story. And people are now nervous that this is the slower growth is the beginning of more slower growth, and then maybe no growth, and maybe it's a hard landing. And so people are quite concerned about that. And I'm nervous about that too. I have to say, I think, almost definitionally, the risk that we have a hard landing here is rising right now as we see the rate of deceleration. I can provide counterpoints all over the place, and I can say, kind of weird that the U.S. economy is slowing this much and everybody else is sort of holding up. If you're looking at, Europe and the UK and Japan and places that are, maybe Japan's a bad example since it's on a very different rate trajectory, but, all these other countries, ex-Japan, are much more rate sensitive, and somehow they're surviving. And so, it doesn't totally make theoretical sense that the U.S. is the one that, crumbles suddenly. And so I'm keeping that in the back of my mind. But I can't deny there's been a lot of slowing recently.
Let me just, before we carry on a whole lot further, let me just timestamp. We're taping this broadcast because we've got a lot of volatility is up. So the VIX is at 24.5 right now. Just to put that in perspective, it was sitting a touch below 13 a couple of weeks ago. So we've seen a pretty big jump in the VIX. And once you get up over 22, 23, you're into what you'd call a volatile market. So our timestamp here is we're taping at 10 a.m. Eastern time on Friday, August 2nd. Just so you know what we're dealing with in terms of the data that's coming through real time. And Eric, I guess we've talked about a few things, and if I you're not always privy to the things we talk about with other guests, although I know you're a loyal listener as well. But the one of the things we've talked about is this whole idea with you that bad news is good news for the stock market and the economy until it becomes bad news. And the whole thinking is here we need to tap the brakes on the economy, which is why we're raising interest rates in the first place, to kind of slow things down, but hopefully not slow it down too much. And then that allows inflation to drift down. And so as we were getting some of these strong numbers in the first quarter of the year, well, that wasn't very good. And that longer term rates and the prospect for interest rate cuts gets pushed back because the news is good. But then all of a sudden, and we've talked about this on previous appearances you've had, all of a sudden in April, May, June, and now July, the numbers that we're getting, most of the reports are coming in, and they're a little more on the disappointing side. And then it's okay. Well, now the Bank of Canada can lower rates. The Fed's going to come to the rescue probably in September now. Other major central banks around the world are cutting rates, and again, we'll leave Japan out, and maybe we'll touch on that at some point. I'll get someone on next week to talk about Japan and the implications of Japan. But all of this kind of bad news is kind of, oh, well, this is good news for inflation, and of course that means lower interest rates, and stocks are looking forward, and so the stock market's been good and bonds have been okay. All of a sudden, though, it seems like just over the last week and a half that the bad news is starting to be bad news for the markets, and this is that increase in the fear of not having that soft landing. And again, we've talked from a stock market perspective of the idea that, and I'll keep going back to this theme because it's so important, inflation peaks, a year later interest rates peak, a year later earnings bottom out. And so we are getting into that period where we'd kind of expect earnings to be bottoming out. So we'd expect to be seeing visually some of that soft data. But it's one thing to talk about it as, oh, this is what happens. And it's another thing to actually see that soft data and go, oh, wait a minute. Do I still want to hold this investment? Or should interest rates be here? Or should the Fed have been cutting already? Are they behind the curve? And that's what happens when you get to this point, when the data has been soft and then, oh, wow, it's looking really soft. Where exactly are we? So that all adds up to, where are we, Eric?
Yeah, that's right. Hopefully, someone listening or watching knows and can let me know. I will say this, Dave, to my very small credit. When we were talking in the last one of these, just a couple of days ago, I did flag that I thought July should have been a live Fed decision. And I feel like you could have very easily justified a Fed rate cut in July just on the basis of pretty material inflation improvement, and it was clear the economy was decelerating, and conveniently it was further in front of the election too, if you think that matters as well. Just even as a starting point, not to say that it would supplant September, but it just gets you going. And so it's a little bit frustrating that they couldn't sort of work their way into doing that. But in any event, hindsight's 2020, I suppose. It certainly looks as though we're going to get some rate cuts going forward. So, in the silver lining department, and the reason the market was initially so keen on economic weakness is, of course, it does pull forward inflation coming down, which has been happening beautifully. And, importantly, in the way that we're actually seeing like service inflation start to ease. And that was really, really stubborn and problematic. And we're seeing shelter inflation ease and insurance inflation and things that were kind of central to the inflation remaining too high story. And so I think that does fit into the economy is not as strong as it is, and that is to a certain extent a welcome and necessary thing. And of course, it does if you're a fixed income investor, you're probably enjoying what bonds have been doing up recently, which is rallying hard. But it certainly does pull forward rate cuts, and it's kind of amazing. And I guess it's worth remembering this, because, and I'd like to think I'm humble in my own forecast, but it is worth all of us remembering this, which is just that if you think you've got central bank nailed down to 3 decimal places out 6 months or something like that, you don't. The surprises are constant and endless, and the narrative 3 months ago was, okay, look, central banks are cutting or will cut soon, but not by a lot. And it's going to be really slow and they're going to cut once and then wait and see what happens. And then a couple of months later, they might cut again. And of course, fast forward to today, and in a Canadian context, we've had a Bank of Canada that cut 2 consecutive meetings. The market's pricing in all of the other meetings for this year. So the market is kind of saying could be 5 in a row, and then we'll see what happens in 2025. For the U.S., which has been certainly the most reluctant of the central banks, the major ones to cut, at least of those in a position to cut. Again, Japan's its own story. The debate was, will they go in September or not? We have said yes to September for quite a while, so I'll take my very small bonus points where I can find them. But it's kind of amazing now. So the market is now pricing more than a 25 basis point rate cut for September. So historically, rate cuts do usually come pretty aggressive and in big increments, and 50 basis point cuts are not unusual, etc. But that really didn't look like how this one was going to go. And now that there's some genuine concern about the economy and less concern about inflation, and I would say they're behind the curve a little bit in terms of the rate cutting they could have been doing. The market right now is pricing in not just one 25 basis point cut, but I guess you could say almost 70% of it's not another cut, but almost 70% of a 50 basis point cut, I guess is the way to think about it. And so we could well have a bigger move. We'll see how things settle. It's not certain that this thing just moves linearly towards 50 basis points, but at a minimum, it's being flagged not just as a possibility, but as likely. It's up to 73%. I just saw an update. So in any event, looking more than plausible. And then Fed's got cuts priced for November and December and January. So now people are thinking the Fed goes at every opportunity. We'll see if this is a bit of panic in light of, some recent notably weak economic data. But that does help, though. Keep in mind, the reason we're all nervous about the economy is high rates are a profound headwind. And so you take that off and it helps. Big long lags and things are such that, of course, you can't, spring back immediately. Yeah. But I will say the lags, I think I can say this, they're big long lags from rate hikes to pain. The lags are shorter from rate cuts to, pleasure, whatever you want to call it, less pain.
Yes.
And so, the idea there being that, it takes a while for your mortgage to be, particularly in the U.S., to, roll into that higher. Isn't even rolling, come to think of it. But in any event, it takes a while for it to hit. But in the U.S., you can reset that mortgage pretty quickly if you, locked in 2 years ago and were paying a high number, and you can get that down pretty fast, particularly in the U.S. And so I'd like to think that the helping hand could come a bit faster. But, at the end of the day here, I've been talking about soft versus hard landings for a while, and we've been saying soft landing is more likely. I still think it is. Keep in mind, there's a fair buffer here, right? Like the U.S. economy just grew at 2.7 or 8? 2.7, right? Yeah, 2.7% in Q2. That's a pretty fast growth rate. Like you can slow a fair bit, which is happening, but you can slow a fair bit before you're into negative territory. So don't get me wrong, we could have a negative, but as it stands right now, I would say I think the more likely scenario is just sort of profound slowing, and we've always assumed weakness for the couple of quarters to finish off this year and into next year. And the debate has been, do you get 1 point somethings or do you get 0 point somethings? And it's not impossible you get a negative point something, but we're certainly getting some form of slowdown. I will note that the unemployment rate that's of course gone up a fair bit. Like the U.S. was 3.4 at one point, and now it's sitting at 4.3. Is that right? 4.3, I guess it is. So that's a fair size move. That's almost a percentage point. That has triggered Sam's rule, which is the whole thing about when it rises. Historically, there often has been a recession, though, as Fed Chair Powell says, that is a statistical relationship, not a causal relationship. It's not that this thing makes a recession. It's just historically you do tend to kind of slip down the slippery slope when you get to that point. So it's not a certainty we get there. I would say don't lose sight of the fact that, okay, unemployment is higher by almost a percentage point, but our view, and a lot of people's view, is that a neutral unemployment rate, the normal rate that you sort of desire in the U.S. is about 4 to 4.5. And so we've moved into it. I mean, there's an obvious risk we slip out the other side before too long. But the point here is, this is not a situation where there are suddenly great, hordes of unemployed people and there's, recession type problems right now. Maybe we have to revisit that in 6 months and check on that view. But as it stands right now, most of the slowdown has been of the benign, maybe soft landing variety. The thing we're nervous about, though, is just overshooting right now. And we haven't overshot yet, but the risk is that could happen in the next few months. And so I've been saying for a while the soft landing likelihood is 65%, the recession likelihood 35%. I think we do need to kind of revisit those numbers. I haven't quite squared my mind what the new number exactly is, and I'm not convinced it's that a hard landing is over 50% right now, despite recent trends. But I would say that the risk is higher than it was for sure. I've been queasy with the way markets were sort of clapping their hands and shouting with glee every time weaker economic data came in over the prior several months. That never felt completely right to me. You could sort of say this is fine and necessary, but I don't know if it was actively a thing to celebrate. And so it does feel as though markets are behaving a bit more sanely as they recognize there's an element of danger as well to an economy that's slowing.
Yeah, and I think one of the key points you made there, and there's a lot to unpack. But Jay Powell and his colleagues on the Federal Reserve Board, they are not Nostradamus. That's not the way they're thought of. I mean, they do the best job they can, but they were arguably late raising rates at the front end of this, and now it's possible they're one meeting late by a quarter point or half point in terms of lowering at this point. And I don't know, maybe we get your thoughts in terms of whether that's material in terms of this, over the next 6 weeks not having this rate cut just that they missed. How much damage does that really do in terms of the long term? But we've got to look at it from a market perspective and say, hey, this is some of the stuff we've been talking about, that we were determined to get inflation down. That fight was going to be fought. You were going to get there. And that meant that interest rates were ultimately going to come down. And we've talked a lot with many of the guests on this program, including you, about interest rates coming down and the opportunity that creates in the bond market, and the opportunity as we start to move through an economic slowdown and a rebound on the other side, that represents in different parts of the bond market and different and you manage through that, and you need to make sure you know what you're doing, or the investment manager that you have managing your money through that has the ability to take advantage of moves throughout the bond market. The bond market is bigger than the stock market globally. There's lots of different areas of the bond market. Some are doing well when other parts are doing poorly, and you want to make sure you take advantage of all of that in, again, what is a likely, over the next several months, the next 2 to 3 years, is a pretty decent bond market. And then the stock market, we've talked about continuously about the dollar cost averaging approach, because as you have valuations in markets going higher, you're at all-time highs. Now, the market is concentrated amongst a small number of names, and those are the names that, by the way, are being hit the hardest. But as people start move from, bad news is good news to bad news is bad news, everything's affected. And so we're seeing a little bit of that over the last few days. Another thing to keep in perspective is the market's kind of back where it was about a week ago. So that's how far things have been moving and how fast the market has been moving. So let's keep this all in perspective. It's also August. We're in the middle of summer, a lot of people away, so trading volume's down a little bit. So this is not an unusual period where you get a little bit of a hiccup. But that dollar cost averaging approach, when markets are at stretched valuations or relatively expensive, you can just get a little shock like this, or a little surprise. And all of a sudden, again, where you have somebody like an Eric or other people who are, or even computers, AI is sitting there going, well, our odds of a recession are going from, 35% to 45%. And that just changes the way you value things. And so when markets are expensive, you see more of a reaction to something that is, somewhat negative. But let's put in perspective that where we're heading from here is, again, we're looking at, earnings likely bottoming out over the next quarter, and an environment where interest rates are lower, and now it looks like significantly lower a year from now. And as Eric says, the pain comes, but the pleasure comes later when interest rates are lower, and sometimes it comes fairly quick. You're probably looking at a better economy a year from now. And so that's kind of where markets ultimately look. So let's not. I think what I'm saying is, let's not overreact to markets going up as quickly as they've been doing. Let's not overreact to markets going down in the near term. Let's look at the value of owning stocks and bonds and a diversified portfolio over the long term, which I hope. Now I can actually look in the camera and say, I hope look in everyone's eyes as they're watching. I hope that people follow that approach. Financial plan, long-term goals, what rate of return do I need? How much risk can I handle? And then let's look over long terms where I want to position my portfolio. And then all that we're talking about in the near term just helps you understand why your portfolio is going up dramatically in value or down in value in the near term. and you check in with your advisor and you make sure that you're still on track to reach your long-term goals. So with that diatribe, Eric, and I hope you caught. I hope you've got that diversified portfolio too. I was looking at you as well, Eric. I know you. I know you're a smart investor, but the whole idea that this is you don't need. We're not looking at a wholesale change in the view. I mean, we knew the economy was slowing. We were going to bottom out at a particular level of growth and then move from there. And that's still the forecast, whether we have a mild recession or which I think would be the only thing you'd be forecasting, or whether we bottom out, at 0 to 1% in growth and then carry on from there in the U.S.
Yeah, and that's well said. Let me start by saying that. Yes, I'd like to think my portfolio is approximating that, just like hopefully everyone else's is. To your point, to me, markets have gotten certainly not perfect, but more savvy over the decades in a way that when they see weakness, they don't necessarily look right through it, but they're able to appreciate it's not a permanent condition. And it's been surprising, frankly, in recent years and even decades how quickly markets can bounce. Even before things start to look good, they just know that things will eventually get good. So I think that's relevant. On the recession side, yeah, if we were to get one, I don't think we're up to a 50% chance. I think it's less than that. Rates aren't that high. The U.S. is less rate sensitive. Other countries are hanging in there. Yes, companies are grumbling about consumers, but consumer spending actually is still growing, and personal incomes are still rising, even on an inflation-adjusted basis. And so I wouldn't say it's obviously has to be a recession, even though the momentum is poor right now. But if we were to get a recession, I think it would be, as you say, fairly short, fairly mild. This would be a mechanical recession induced by high interest rates. It is not because banks are failing. It is not because of pandemics or global financial crises or other extreme adverse events that take quarters and years to figure out and resolve. That this would be a more temporary thing and one that you could then talk about the economy bouncing back or something like that in 2025. And so for medium and long-term investors, not to say it's completely insignificant, but maybe it's an opportunity to be. Remember, you want to be greedy when markets are scared, and vice versa, not to a dangerous degree. But the thought process should be, okay, when is the time to get a little greedy here if we were to see this continue to play out?
Yeah, and I know for regular listeners right from the start of this podcast, they'll be tired of hearing this analogy, or anyone who comes out and watches our presentations and anyone who's one of my colleagues. But I keep going back to a lot of what we're still experiencing is an offset or still the residue of the pandemic moving through. And the analogy that I was drawing is the idea of you're standing in a swimming pool. You got a volleyball in your hand, actually, I guess maybe a water polo ball, given the Olympics on right now, and Canada having some moderate success in water polo relative to its history. And so I've got my ball. And what did we do during the pandemic? Well, we took the ball and we pushed it down and we held it down underwater because we locked down the global economy. We had to do that to take care of the pandemic. That was the most important thing. We get vaccines. We learn to live with the pandemic. Now, in the meantime, by the way, interest rates go down to zero. Governments spend trillions of dollars all over the world. So that's a factor here. But then what do? We open up the global economy. And what do? We effectively release the ball. Now, if you do that in a swimming pool, the ball shoots up over the surface of the water. It doesn't just float up and go along like nothing's happened. So we have that overshoot. We have to dramatically increase interest rates, again, to get the ball to come back and settle down on the water. And we've been kind of in that process. And the ball, it's funny when you do this. I remember as a kid doing this. It seemed like the ball kind of shot up and just sort of kind of hovered there. Kind of like Michael Jordan coming in from the foul line, and then it would boom, and then it would come down, and that's kind of what we've been going through over the last maybe 2 years, where we've been waiting for that ball to come back and settle down, and then what you're left with is an environment where the economy going forward's likely growing, inflation has normalized back down to a level we're comfortable with. Interest rates are lower than they are right now. So from a historical perspective, relatively low. That's not a bad place to be, right?
Exactly. My main takeaway was the Olympics are happening now. But yes, I think the rest of it was good too.
Well, and a swimming pool is a good place to be. You can have a lot of fun as a kid in a swimming pool, and you can learn about economics at the same time. So how you got to like that because you're an economist. You want
I like
people
it. I like
love
it.
economists?
Everybody loves
All
economists.
Right. Well, I don't know about
or
that.
not, or not.
I can tell you some stories in high school about that, and you probably have similar stories, but about the love that people have for economists. But with I'll share that with my my psychiatrist and not the listeners today. So, Eric, thanks for this update. Uh, because of what's going on, we'll ask you to stay close, and we may get you on again if anything, if we see a continuation of this. But or if your forecasts change dramatically as you again, I imagine you're going to spend the long weekend working 25 hours a day as you always do. So we'll have some new forecasts from you next week, and we'll be excited to hear about that. So thanks again for today, and thanks for coming on earlier this week, and thanks for everything you do.
Yeah, my pleasure. Thanks for having me. Nice talking to everybody.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.